This is Tom Aspray with the Viper Report Market Wrap video for the week ending November 15th. What a difference a week makes. Some of these top stories can give you a little idea of what's roiling the markets last week. We look at the technicals over the week. They've seen some pretty significant changes. Of course, the main question, which I will deal with, is whether it changes the major trend we saw in the advanced decline line heading into the election. So obviously the cabinet picks by President-elect Trump have not gone over well with apparently investors. They may have voted for him, but they're not too happy or they're nervous. We've always told you that uncertainty and nervousness in the market is never a good thing. This was combined with comments from Fed Chair Powell about future interest rate cuts. That didn't help. And, this graphic pretty much tells the tale of what happened to the stock market this week. This table from stock charts shows you kind of what a week it was. Gold and the IWM small caps both down over 4%. Then the NASDAQ 100, 3.5%. S&P actually held up pretty well at 2%. And down into the utilities were up fractionally for the week. But they're one of the few areas that came our way unscathed. Not a better picture for the sector rundown. XLK down 2.5%, XLC down 2%, and XLV healthcare getting smacked again. Those three were all weaker than the S&P 500, and all the rest of these did better in terms of a relative strength, but only a small gain of 1.5% in the XLU, and financials and XLRE were also positive. So in last week's discussion, this is where we closed in the SPY. We are testing, a potential resistance level up here. We'd exceeded some of the pivot resistance levels above the Stark band here for 3 days in a row. And those who didn't take that into account paid the price. You can see below here at that point, the AD line was above its moving average and positive, still below this high. But when the start of a new rally, you usually look for a little bit of time before that counters. So as of Monday's close, that still looked okay. We're hitting that resistance. Pulled back a little bit on Tuesday, flat on Wednesday, and then Thursday, we closed below the prior 2-day lows. Comments in the afternoon from Powell that, not in a hurry to lower rates some more didn't help, and then as well as a bunch of new cabinet appointees that the market seemed like it had trouble stomaching. So, that resulted in Friday's action as we're back to the 20-day EMA, and of course we're back to the October highs. Prior highs, once they're exceeded, become pretty good supports. So that's first good support. Then if you look at additional support, right around 575, and then you could go down to the major support here in the 565 area. The pivot is still well above the pivot at 573. So, that's, 12 points below where we closed, or about 2%. So one of the factors I think we may determine how deep a pullback we get, and of course it's possible that most of it is already over. You can see we're already back to the Stark minus band, is the action in the interest rates. You can see that, 10-year T-note yield back up to the highs. We've had this divergence in the MACDs, but you really, as I pointed out last time, you really need to see a sharply lower close. Ideally, drop below this 4.363 level, and then, this low looks to be pretty pivotal at 4.264. Time-wise, that should happen in the next couple of weeks. So maybe into Thanksgiving week. Could happen, could come at any point. There's a big auction on Wednesday, so that may change the bond market's outlook. Of course, looking at some of the individual markets, your time frame is very helpful in determining what kind of damage was done. So this has been one of our favorites, the XLC. You can see it did close down, 2% roughly after pushing up to, pivot resistance. If you look at from a weekly, you look down at a daily chart, a much different picture. We had formed a doji on Wednesday, and then low close doji sell signal on Friday. So, next support here, not too far away. And of course, you look at as we mentioned last week in our updates, by Wednesday's close, we had seen, the fact that higher highs in the NYSE as well as most of the other averages. QQQ is different because the AD lines did make a new high, but you can see here in the S&P, lower highs. Okay, so that's a divergence, we're dropped close below the moving average. So this is next important support. So you see a couple of scenarios. If we can stage a pretty strong rebound this next week or so, we could flip this back above the moving average. However, since we closed below it, you have to have a more negative short-term pattern suggesting, okay, well, if we break these lows, we have next support here at the August high. If you break, this support, or down here, we have a similar support in the stocks only, we're going to likely hit stronger support. All right, you can see also in the NYSE, we're showing a pattern of lower lows and lower highs, and if we drop below that, lower lows. So that'll be a new downtrend. Of course, daily divergences need to be viewed in light of the weekly picture. So we have the S&P, the Spider Trust Weekly. You can see we made a sharp new high last week and gave up, a good part of those gains this week. All right, so, and the weekly AD line, because we made a new high this week, it's not a new closing high, you can see slight divergence here in the AD line. All right, so that also tells you how important that last low was. Similar pattern you see in the stocks only as in the NYSE All. So another sharply lower close this week could take the AD lines back to their moving averages or even below it. So does that mean the start of a bear market? No, typically that would probably set the stage for a bit more weakness, maybe into the, 560 to 575 range. Remember the pivot's at 575. The rising 20-day EMA is at 563. So you got to think of the stock market as a super tanker. If we lose some upside momentum here, it doesn't mean it's going to totally reverse course. So I'd be looking at further decline. If we get it, we'll present a buying opportunity, but the next week will be trickier. If we look at the daily chart of the Qs, we can see we made a sharp new high above the R2 here and gapped to the downside pretty sharply on Friday. AD line shows no divergences here. Once again, you can draw an uptrend connecting these three lows, and we're getting close to it right now. But it also has a number of levels of support here that, next level right down in here. And even if you break that, the strong support is much stronger in here. So I think it'll be well supported, if we do see additional selling. A little surprising in the RS analysis, in that, it reversed back to the downside. We talked about the fact that it taken out this high last time, but not this. And so that was, it needed more strength last week, and we didn't get it. If you look at a weekly chart, also no divergences in a very strong trend here. That's what we've been saying really since, the fall of 22, since the bottom, down in here. And, you're still seeing a really strong pattern here in the AD line. So, I don't think the overall market is suffering a major failure up here, but certainly the sentiment has really shifted. And from past experience, that when people turn quite bearish, then they're often selling out at the lows, and I would not be panicking at this point. Looking at the extent of the selling, the buying on the upside in this last spurt here, was still stronger in pretty much all the markets. This is the S&P, 40% down. We didn't have any climactic sell-off that we got, in August. We could still happen this week, though we are testing the 20-day moving average. It's rising, so typically, you're going to see some stabilization there, possible filling of this gap. S&P 1500, similar sort of, stronger buying here than we've seen selling so far, but the selling is getting closer to matching it. And in the Qs, the selling was the heaviest. 80% were down on Friday. So that cluster, that couple of days on the downside, probably canceled out the last post-election rally. New high, new low on the NYSE. Did not see anything dramatic. We'd made a sharp surge above 400 as the market had its recent high. No pickup in new lows on Friday, so that's a good sign. The NASDAQ composite, there was signs. We got 296 here, so that's the highest level since it too has reached some good support. So, once again, you don't turn that tanker around on a dime. It's not like a Chris Craft, and so patience is often rewarded. Growth took it a little bit on the chin last week. The IWF-IWD ratio is down 1.5%. Still above its 20-day moving average, and so now, this support going across these lows is becoming more important, and of course the high we made last week. So we need to get back above this high to shift to signal that growth is going to outperform. Personally, I think we've had a couple of years of pretty strong either growth or value. Not be surprised to see where they both go up or decline at about the same rate. MACD slightly positive here, but the histogram narrowed last week, so once again, this week's close will be important. Looking at the short-term 60-minute of the Qs, which for traders, still we're still actually long from our trading longs back in, I guess right around in here. We're back into some, a pretty good level of support, down to 5. You can see 43.75, 485, and 477.40. Is where our stop is currently used. So I'll be watching a rebound back in here. If it's not, strong, then I'll look to lighten up that position for subscribers. No real strong warning signs from either the VIX or the VXN. They both rose pretty nicely on Friday, but they really need to get above these resistance levels to suggest a new trend, and that will take some time. We commented last time that just before the election, put buying had been quite heavy. You can see it's much lower now, so that probably will change early next week to see if this pullback has legs. If it's a brief setback like we saw in Brexit, we're really not going to know what the implications are of the cabinet picks, what that's going to mean for healthcare, defense spending, etc., well into 2025. Looking at the T&J's ETF report, we dropped, from 78.7% of the ETFs above their pivot down to 56.9. So we're still watching that 50 level. There were a number of new sell signals from the weekly DTS. Here's the list. So you have ARKG, emerging markets, gold miners, gold ETFs, biotech rather. IBB got hit pretty good. Some of the miners that started to raise their head looked interesting. Fortunately, didn't pull the trigger on those. Silver also, and then U.S. oil, materials, and another XBI. So it was a pretty rough week. No weekly buy signals. You can see that the SPXL, the triple leveraged, formed a doji on Wednesday, and then it got hit hard. It's already down towards these stark minus bands here. Daily indicators are negative, but the stochastic confirmer is still, in overbought territory. So, action early in the week. Most of you know that after that kind of a decline, if we're going to get a failing rebound, it'll often last only a couple of days. So, if you're uncomfortable with your long positions, that means we get a bounce into Tuesday. If the market's higher on Monday, that is, that might be a time to reduce your exposure and have a more relaxing Thanksgiving. There are a number of 5 ETFs with readings above 50%. Energy had nice 66.7%. XLY also 66.7. 90 for XLF, one of our favorites, and 66 for tech. So it's kind of pulled back here. It'll bear watching this week. And XLC, despite the 2% drop, still 83%. So, negative signals from the rest of them, and only, as I pointed out before, only 3 sectors beat the S&P last week: XLF, XLE, and XLU. Looking at some of the signals, semiconductor here hit pretty hard. We didn't really like another rally failure, up above 260, and they certainly pulled the plug on that. You can see that what's positive, a weekly, 3-day, all of these are still positive. Okay, we had daily sells in the Qs and in technology and in consumer staples. The real red here is in staples, healthcare, real estate, and materials. If you look at our Viper ETF positions, you can see that something like the value really got hit hard, is back into support here. So, but it's didn't hold this October high. It's in contrast to the VTI, which is still well above its October high. QQQs, back into support, but it was hit pretty good on Friday. XLF, that's the kind of strength you like to see. KRE, KBE also look pretty good. XLY looks really strong. XLC still positive. Cloud, is well above its support level. And we just hit our buy levels in VBK on Friday, so you can see it has support way down in that level. So I still think that this is a legitimate move higher in the small caps, but we'll know better in the next couple of weeks. In terms of new stocks to take a look at, probably have a pretty cautious approach going into next week. Watching that rally, we added some positions, Valero and Energy, and actually it gave a weekly DTS last week. Sort of a mixed bag in energy still. We don't have any ETF positions in energy, but we're watching several of those closely. Industrials right down to that 50 level. Consumer discretionary still acting great, and staples acting lousy. Healthcare even worse. And you look into financials. Here's there's not a lot of new green there to trade off of. Information technology is sort of mixed. Look like it could be a turnaround in Microsoft and Intuit here after last week's action. Still some problem in the tech area with Broadcom and Texas Instrument. And communication services, Meta has, if this is pullback's going to be over in Meta, we want to see some improvement. You can see that the 4-hour, 1-hour, daily, and 3-day is negative. So, not too early there to be bottom fishing. Utilities also, nothing there we see that you like. I'll be updating some of the tables on the Viper report this week and our current positions. We've given up some open profit, but only really have not been stopped out of anything yet at this point. But we will be watching those stops carefully and adjusting them. And if you're interested in starting off 2025 with a better understanding of the market, you might want to take advantage of this special on the advanced decline course. It's a 50% offer. It's 6+ hours. I'll teach you step by step on how to use it, how to follow it. No special software is needed. And those that have taken the course really have been given a much better understanding, their words, not mine, of the way the financial markets work. So you might need a seatbelt, or some Dramamine for the week ahead. And if I see anything dramatic midweek, I may do out a short video. Thank you very much.